It's Angie from Happy at Law. Let's talk about what the heck is a venture capitalist. Okay. So, your early stage in your business, you're developing, could be lots of different things, a product, a platform, a very cool software application. Lots of folks are developing things using AI tools, combining AI tools, and you need some cash in the door to finish building what you're going to sell. So a lot of people think of, oh, we'll get VC funding, we'll get venture capital. And it's an interesting step to go to because a lot of people don't really understand what a venture capitalist is, what a fund is, what a fund does. Um, and it kind of fits in the bigger category of private equity. So today, I'm going to explain to you what a private equity fund really does, what it's like to work with them, and kind of in that same boat, why venture capital might be a great idea for you and why it might be not worth the money. But background you'll need to know in order to make an informed decision for your business, because that's the most important thing, is having the information and the basis to make the decision that's right for you and your business goals and values, right? Okay. So first thing we want to talk about is, what is venture capital? It's kind of in the name. It's funding, it's capital for a new venture, right? And there are groups, funds of people where people with cash to invest put their money together and create a fund. And then they'll go out and find entrepreneurs at a really early stage of their business and fund that business in exchange for usually stock, sometimes an option to get stock backed up by a loan, different structures. But basically, I'm going to give you cash. You're going to give me a percentage of your business. You've seen a tiny version of this on Shark Tank, right? The people go on the show and they pitch, take 20% of my business in exchange for $1 million or whatever they think they need for their next step, right? And the discussions that you hear are the analysis that a venture capital firm goes through in an abbreviated kind of summary way. The analysis they go through to decide if that percentage of your business is worth the amount of money they're going to spend on it. So you can think of a venture capitalist as a person who's going to invest in your business and take a bet on you, right? And your idea. Now, what's the difference between a venture capitalist and an angel investor? The difference is what stage you're at. So an angel investor is basically like a guardian angel. They swoop in and they invest in your business and keep you going when things look the darkest, right? I want you to think about this. We call them angel investors, but there's nothing inherently angelic about it. They are there to make money. They are capitalists. Getting profit on your invested capital is what capitalism is. An angel investor is a capitalist. They intend to get paid for the risk that they take. So the earlier in the process of developing your business that you are, the bigger the risk the investor is going to take on you, and the bigger upside, the bigger profit, the bigger benefit they want on the other side. So an angel investor might be the best thing for your business. It might save your bacon and you become wildly successful one day. But they don't do that for free. And that's the most important thing to know. So going into these types of deals, whether that's if you're doing an incubator, a Shark Tank style incubator, where you're going to go and make a pitch and look for funding, all the way up to somebody's uncle knows somebody who knows somebody to get a private one-to-one meeting. I want you to think in the back of your mind, this person is here to make money and to get a profit on the risk and the capital, right? Capitalism is capital times risk equals profit, right? For this purpose. That's how I want you to think of it. So when you're thinking about whether you want to take that investment, there's a few things to keep in mind. What do we always go back to here at Happy at Law is it a values alignment? These people are going to be in your business. They don't just write a check and walk away. I don't care what they tell you, right? If you had $1 million of my money, I'm going to show up. I'm going to check on you. So think through, how's that relationship really going to go? And that relationship needs to be more than the discussion you have. It needs to show up in your contracts, right? What do they have the right to vote on? What do they have the right to make you do? Do they have the right to bring in other investors, right? Do they have the right to make your ownership percentage smaller because they want theirs to be bigger? These are all reasonable terms that end up in some of these funding agreements, and you need to think through how you're going to feel about that. Because you may, by taking investor money, put yourself at the back of the line to get a profit on your own new business venture. That's an okay decision to make, but make that decision on purpose. Don't accidentally end up in that situation. All right, so that's venture capital. Let's talk about how that is a little bit different than private equity. I want you to think of a private equity fund as the business equivalent of a house flipper. They come in and they will find a business that's got a good business model, maybe a good market position, but for whatever reason, they just haven't made the kind of profit they expected. Maybe they fell on hard times. Maybe there was a weird market downturn that affected that business, right? And they're just short on cash flow. Or they want to go out and build a new facility or do a big expansion, and they just don't have the funds. This is where a private equity firm can come in and sort of save the day, because they go out to their investors. A private equity fund is an investment fund. Private equity has their own customers and investors. They pool that money. They go find a business that they believe will be profitable with a little extra capital push. And then they have a 3 to 5 year window to cash out of that business and return money to their investors, right? You see how that works? They're house flippers. They're business flippers. So they have particular needs for that business to perform in a certain way. A private equity firm will want to maximize profit and revenue on the books, generally speaking, and minimize capital expenditures. Now, why is that? So you look crazy profitable, because those books are going to be used to sell that business to the people that want to hold it and run it long term. So if I came to you and said I had $20 million of net profit because I spent a lot on maintenance and capital expansion last year, right? You're going to value that business at 20 million times a number, right? Number depending on the industry. And that's going to be the purchase price. But let's say I can defer maintenance and I can defer some capital expenditures and I can hold salaries flat, and maybe I do a bunch of layoffs and get rid of people that way, cut my costs. Then all of a sudden on my books, my expenses have gone down. That 20 million of profit turned into 40 million of profit. I apply the same multiple, and now my business is worth $100 million instead of 80, right? So I'm going to get more money for my investors if I'm the private equity firm. Now, I say this with no judgment. Those decisions during the ownership and participation of the private equity firm have long-term consequences for the business and the future owner. Someone will catch the capital expenditure and maintenance hot potato. And the private equity firm is going to try to not make it them. They do not want to catch a hot potato, right? That's okay. there are adults in the room having these conversations and making these analyses and making their own decisions about risk. But for you as the entrepreneur, particularly at an early stage, you want to think through whether you feel okay about that for your business. You see how that works? So if the angel investor is sort of the person who comes in to save the day, so is the private equity firm, but I want you to think of them as a flipper. Now, if they're the house flipper, who's the long-term owner, right? Who's the landlord who comes in to buy the apartment buildings and hold them for long-term and be a great landlord, right? And those can be an IPO that returns the business to stockholder ownership, maybe publicly traded. Some businesses will go private. Somebody else will come in who's got money, who likes that business, who wants to buy it and run it for the long term. Sometimes those are individuals or other companies in the industry. Big fish gobbles up the little fish. You see this a lot with social media companies, right? You'll see Meta or X or Microsoft will come in and acquire. We won't talk about Sony because we're bitter about Bungie. At my house, we're bitter about Bungie. But you'll see the big fish come in. They see a business they like. They'll buy it. They'll cash out the venture capitalists, probably cash out the founders, and then continue to run that business. And sometimes you see an acquired business struggle because it's been burdened by deferred expenses, deferred maintenance, deferred capital expenditure, right? So when you understand the motivations of these different players and how they fit into the big picture, what they do makes a lot more sense, and the outcomes start to make more sense. Okay, so let's talk about some alternatives. Sometimes when people are in tech, they're doing a tech startup, they feel like they're on a path, right? A well-worn path. You come up with your idea, you build a proof of concept, you build an alpha version, you go to pitch meetings, you do incubators, you get funding, you go to beta, right? If you've heard the phrase bootstrap, that's when you're using your own money or maybe your mom and dad's money, right? Depending on if they've got funds they want to give you. Hey, don't be sad about that. That's how Bezos started, right? He borrowed money from his in-laws to start Amazon. So maybe you've got some source of funding, right? You're willing to put your own money where your mouth is. And that may be enough to get you to a point where you've got your initial product out there and you're generating revenue, and you use that revenue to start paying yourself and grow the business. Totally legitimate way to go, but bypasses the incubator path. So if that's a possibility, why do people take this incubator, private equity, VC path? And there's a couple of reasons. One is they don't have the funds, right? The other reason might be they have the funds, but they want to grow faster. They don't want to wait for revenue to do the next stage of growth. That's a value judgment that they make about their business, right? Another reason might be they just think that's how everybody does it, right? So come here, tell your Auntie Ange the truth, right? Does your ego have you thinking you want to be able to tell people that you got Class A early stage funding from muckety muck VC firm, right? Or do you really believe in that model as the best way to fund your business? Because that understanding of yourself is going to have ripple effects down the line. Me personally, good deals have been done both ways. So I don't have feelings about which path is better or worse. The paths have different costs and benefits. So what I want you to take away from today is that nobody's giving you money for free out of the goodness of their heart. They may have wonderful things to say about your idea, your stage of development, and your growth to date. They are giving you money because they believe they will make money off of your business. They'll do that in exchange for a percentage of ownership, maybe a loan agreement where you're going to pay interest and they can convert that to a membership interest. Maybe they're just wanting to loan you money, straight up loan you money, and they want a personal guarantee from you. They're giving you money because they expect to make money, right? But they know, because they're sophisticated investors, they know they're taking a risk on you, and they are going to get paid for that risk, either in an interest rate, in a future valuation, or in an ability to take over your business and run it if you don't do what they want you to do, right? So we're going to be smart entrepreneurs. We're going to be grown-ups. We're going to be clear about our own motivations and understanding, and we're going to make good business decisions, right? Okay, let's get out there and get funded.